Hello, my name's Charles Delastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax and estate planning. So today's video is around the different types of life insurance that are effective for dealing with avoiding inheritance tax. So welcome back. So the first thing is to consider that these plans should be taken out using an independent financial advisor. It's often cheaper using an advisor than going directly to the insurance company. So an advisor could charge you a fee instead of taking commission, and that will reduce your premiums on a monthly basis. And on a policy which may last 20 or so years, that can save you thousands of pounds over the term of the policy. Okay, so there are different types of life insurance suitable for avoiding inheritance tax. Now, you have to understand that using a life insurance policy doesn't stop you paying the tax. It actually pays the tax due by paying a lump sum to HMRC to cover the liability that you have when you die. Now, of course, that may mean that you are either overcovered or undercovered, so it's essential to calculate the potential tax properly. Otherwise, you're going to be paying too much or too little. However, I would warn you not to use a simplistic approach relying only on a life insurance policy. You really need to develop a well thought out financial plan for inheritance tax management firstly, and then in that plan you determine which assets you're going to keep in your estate until you die and which assets you're going to remove from your estate over time. So then you would use a whole of life policy to cover the assets that you're going to retain to pay the potential tax. Now, married couples should consider a joint life second death policy because obviously inheritance tax should only be payable on the second death. Now, I do have other videos on my channel explaining how these plans work in much more detail. But here's a point to watch out for. Whole of life plans require continuous premiums up until death. So make sure that your ongoing income stream will be more than sufficient to meet your premium obligations, even in the event of long-term care or other issues to that effect. Okay, so what about assets that you are intending on gifting away out of your estate? So if you're intending on making the gifts now and they are over 325,000 allowance, only then will there be something called taper relief. Now, you could use a type of plan called a gift inter vivos policy that is generally cheaper than flat level term assurance over the 7 years. The reason is these plans are designed to reduce in cover as the potential tax drops over the 7-year time frame. Now, for assets that you intend to remove over time, but you're unsure how long it's going to take you, a maximum whole of life plan may be suitable. Now, they insure you for 10 years at a fixed premium, but after the 10 years, the premium could double or triple after the 10-year point. So, however, those plans are still very useful for extending the cover if, for whatever reason, you haven't removed the assets from your estate entirely during that 10-year period. Okay, so life insurance, lots of different types here. It's really important you get experienced advice, make sure the calculations are done properly, and even more important than that, use an independent fee-based financial planner to help you make sure that you're making the right decisions around your life insurance. Okay, thanks for listening. Hopefully you found that useful. Bye for now. Bye.